There are other reasons that companies choose not to go private. Not just tech companies, but tech companies have their own reasons for doing it. The first is they want patient capital. They don't want people running in and out. As we'll see in a few minutes when we take a look at what happens when tech companies go public, it can end up being quite a disaster. So in this case, you want patient capital, you want simpler compliance. It costs millions of dollars a year to deal with a publicly traded company and the compliance and the securities commissions that go with it. They want partial liquidity events. So it's much easier for a founder to get a partial liquidity event on a private transaction than it is on a public one. And then they want strategic partners. In other words, these are investors that are actually investing in helping them run the business. You know, when they're selling, shares in the open public market to investors, these investors are not actively involved in the business. They're just investing to try to get a return on their money. And if we take a look at what's going on in the IPO market, this is around the world. For the last 10 years, on average, $200 billion a year. So public companies are still raising money, in this case around the world on a global basis, $200 billion a year. But that is 25% of the share buybacks for all global companies. Okay, so if you look at it from a different perspective, $200 billion a year, 10 years, $2 trillion. But it also means that $6 trillion was kicked out of public markets, not allowed to be put back in. So that money has to be invested productively somewhere. And private equity isn't the only option, but it's certainly an option. And if we take a look at institutions, this shows that 65% have an allocation to private equity, and in fact, all of these other categories, most of which are actually private assets. When we look at individual investors, this is an example of Tiger 21. To be a member of Tiger 21, you have to have $10 million of US dollars of investable assets. Their asset allocation for private equity is over 20% and has been that way for a significant length of time. And as of this last year, it was almost 30% in real estate. So between the two, their allocation to private equity and real estate is slightly higher than 50%. Now, one of the things that is true about public markets is you have liquidity. And liquidity is supposed to be connected to safety because you can obviously decide to get out of the market in relatively short notice, sell bonds, sell stocks in public companies. So let's examine this. And these are some companies that David was referring to. So he didn't refer to this one. This is just an index of cannabis stocks over the last 18 months, which is now down 60%. It might have been better if they stayed private. And of course, we know what's happened to Bitcoin in terms of its run up and run down over the last few years. Tesla in, I guess, January, had a market value second only to Toyota. Now, Tesla makes, if they were lucky this year, 500,000 cars. Toyota makes almost 12 million. So Tesla has a greater market value than at least two of the three German auto companies combined, and has nowhere near that profitability. Now, people say, well, eventually it'll get there. Okay, but nevertheless, Tesla stock dropped as of Friday by 36% over the last 3 weeks. So that's a volatility issue. That's liquidity. And if we just look at the stock market in general, for the last 20 years, the S&P return, as I mentioned earlier, is kind of in the 6% range. It's not huge. It's not terrible. It was making a profit overall. And while that was going on, it had two drops in the dot-com bust and in the Great Recession of more than 40%. So what you get is a lot of volatility when you have liquidity. Now, just by a quick show of hands, I can't see everybody, but how many people here have watched the movie It's a Wonderful Life? Most of you? Well, maybe half of you. Oh, the other half have not. Okay. Okay, just quickly the story. George Bailey, played by Jimmy Stewart. It's during the Depression. Well, it's part of the story is during the Depression. And he's running a savings and loan. And I'm going to relate to a particular aspect of this story, the movie, when he was, the early part of the movie. So he gets married, and he's just about to head off on his honeymoon with Mary, played by Donna Reed, and they're in this cab. The cab is driven by a guy named Ernie. Now, Ernie's best friend is Bert, and now you know where Sesame Street got those names, okay? And they drive down Main Street. There's a run on the bank. And Jimmy Stewart is waving around $2,000, which in today's dollars would be somewhere between $50,000 and $100,000. And they're going to spend the whole amount on their honeymoon. They're going to go to New York and Bermuda. And they keep driving, worried a little bit about the bank, and then they realize that there's the same lineup at the savings and loan, which he runs. So they stop the cab, they get out of the cab, they go over to the savings and loan, and there they're trying to save the day. And all the people are rushing into the savings and loan, asking for all their money back. And the scene looks something like this. Now, what Jimmy Stewart is trying to tell all of these people, he's saying, look, Fred, I don't have your money in my vault. Your money is in Bob's house. And Ethel, your money is in Mary's house. That's what we do. We lend you money so that we're lending money from all of your deposits to you. We cannot cash in everybody's accounts. Now, people are still screaming and yelling, and some guy runs in there and says, did you get your money yet? And one of the guys says, no, oh, don't worry about it. Potter, now Mr. Potter is like Scrooge. He's the evil incarnate. And he's trying to take over the town and buy things cheaply. So he's offering 50 cents on the dollar for all the deposits in the savings and loan. So here's the interesting thing. What he's offering is liquidity at a major haircut. And what Jimmy Stewart, as George Bailey, is saying is, look, the only way you get a return in your savings account is it has to be invested in something that's not liquid. There is no bank, insurance company, anywhere in the world that is made up primarily of liquid assets. In fact, there's no operating business that's made up of liquid assets. What are the liquid assets of Microsoft? What are the liquid assets of Google? Cash flow, goodwill, infrastructure, human resources. What are the liquid assets? Not much. Maybe 10% of their entire balance sheet or market value. So the point is that really we make a return on assets by committing them to a period of time that's not traded on a daily basis. These are some of the world's largest companies worth billions of dollars. There are a lot of other kinds of illiquid assets. For example, your home. Now, granted, subject to whoever's in power provincially, normally your home will rise in value over time. That's not so true today, but it's a cyclical thing. And another private asset that tends to do well over most periods of time is art. Although I will tell you this, I tried to sell my Beavis and Butthead chandelier on Craigslist, and I found no takers for it, so there are exceptions to this rule, just so you know. When we take a look at private companies that choose to go public, Uber is a good example, we can see some interesting patterns. This is what occurred last year with Uber, Lyft, Slack, and Pinterest. All of them in the same year lost between 12.5% and 48% of their market value after their IPO. And the one that never got to go public, which is a complete unmitigated disaster, is WeWork, which basically went from $47 billion of estimated value to $5 billion, and I would say $5 billion is a major stretch at that. And obviously they canceled the IPO.